Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Alix Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at why shares of the Danish drug maker Novo Nordisk dropped the most since late December.
Plus, we'll discuss why the department store Kohl's gave a weak sales outlook for the year.
But first, we begin with the computer technology company, Oracle.
This week, the company's shares fell after it gave a sales and profit forecast for the current quarter that fell short of analysts' expectations.
For more, guest host Isabel Lee and I were joined by Anurag Rana, Bloomberg Intelligence technology analyst. We first asked Anurag for his take on Oracle and why investors reacted negatively to its earnings.
Yeah, the little bit lightness in 4Q that you alluded to is primarily due to supply challenges, which is, the data center expansion everybody's undertaking. So the realization of revenues from that, I'm to be honest, a bit surprised about the stock reaction because the company gave 2 or 3 really interesting nuggets for us to chew on. The first one was very large bookings in quarter, though. So their remaining performance obligations or the contracts booked, spiked up 63% to 130 billion. Wow. And along with that, for their FY26, which starts in June, and FY27, they talked about sales growth of 15% and 20% respectively. So those are very strong numbers. So we are a bit surprised about the reaction.
How did Oracle and other companies really react to Chinese upstart DeepSeek? I mean, they released an open source AI and that torpedoed basically the whole AI outlook. Did they mention it in their earnings call and in any of their statements?
Yeah, so they were already talking about some of that impact, but these guys reported very strong bookings. But I think your question is probably the most important one right now, because I think one reason for the stock selling off, despite these bookings, could be, does this trade continue going forward in the next 2 years or so? And I think that's really why people may be skeptical that 20% growth they're talking about 2 years from now, how dependable that is, depending on, do the companies such as the cloud vendors keep on spending very aggressively on capital expenditures?
Margins, profit margins. What would you learn at Oracle? I know some folks are calling that out.
Yeah, so we think they're going to go down next year. They really did not address that issue because I think they're going to talk about it in 4Q. See, when you take up your capex from 7 billion to 14 to 16 to 20 over the next, just let's say 2 years, it's going to have an impact on profitability because the business that's coming in, it's less profitable than your core database business or your applications business. So we think margins are going to be dented by 100 to 200 basis points next year. Consensus doesn't have that figured it in their outlook at this point. We think those numbers do come down.
Our thanks to Anurag Rana, Bloomberg Intelligence technology analyst.
This week, I was at CERAWeek's Global Energy Conference in Houston, Texas. It's where all the energy CEOs and officials meet to discuss policy and make deals. And I had the pleasure of speaking with Larry Coben, CEO of NRG Energy.
NRG Energy is involved in energy generation and retail electricity, and it provides energy and related services to residential, industrial, and commercial customers.
Larry Coben and I discussed power demand and energy costs, and I first asked him if rising power growth is driven primarily by data demand and AI.
I think it's a lot of things. It's also onshoring of manufacturing. For example, here in Texas, there's a 1 gig Samsung plant that's going to be opened in a couple of years. It's the Internet of Things. It's smart homes. It's electric cars. People are just using more electricity in ways that they never did before. And as a result of that, that's part of the demand cycle. Obviously, data centers are a big part of it, but data centers aside, all of the people who build data centers also are involved with cloud and a whole slew of other services, search, that we don't think about because we've had them for so long. But the growth for those is increasing every bit as much.
And you guys are one of the largest independent power producers in the United States, right? So you can really take advantage of this. Where is the biggest demand for what kind of power? Give me some insights into the conversations you're having right now.
Sure. I think competitive markets, the two biggest ones would be Texas and PJM in the Northeast. Texas is a primary focus for us, though we do have a strong PJM presence. One of the things we like about Texas is it has a friendlier permitting environment, and it has one public utilities commission and one governor. ERCOT has 13 states in it, plus the District of Columbia. So that's 14 commissions, 14 governor-like people, and FERC, which doesn't have any jurisdiction here. So, but I think you're going to see data centers in all of these places and in other places where economic growth is going on. It's not going to be limited, but I think Texas is going to be first.
Do you think that the hyperscaler hype about how much they're going to spend on power demand is real? Or
Yes.
is it going to fall short?
I think yes. I mean,
It won't fall short, or
it will not fall short.
Okay.
It may even go up.
Okay.
And the reason I think that is, it's interesting. After DeepSeek, everybody was super concerned about that. And then 3 of the hyperscalers came out and essentially doubled their capital commitments. Now, if they actually, after looking at DeepSeek, decide it's going to be twice as much, then that gives me a great deal of comfort that the power demand is going to be there. And, I know everybody's talking about Jevons paradox because everyone has now Googled it for the first time. I'm actually old enough to remember what it was originally. But, I think people will start using this more and more. I already see it in our business. We are using enormous amounts of AI and customer service, and we're only just scratching the surface.
Speaking of, you're going to be developing 5.4 gigawatts by 2032, right? How much of that is going to be fully contracted, and how much of that will be more merchant spot price?
We have a 1.5 gigs that is shovel ready. That will probably go, most of that will go directly into the Texas market.
Okay.
Anything we build beyond that, I would anticipate would be fully contracted for, related either to a data center or another kind of large user along the way. We are not in the business of taking merchant risks. Some of the other folks are. But we actually like to protect our downside and give ourselves a lot of optionality to the upside so that we don't have to care whether the growth is 2% or 10%. Both of those are ginormous for us.
So what kind of pricing are we talking about for a gas-fired plant, for renewable, for other power? Like what does it look like right now?
I mean, gas-fired plants, we think they're going to be done for $1,500 to $2,000 a kW installed. The ones that are shovel ready, because we started on them 5 years ago, will be much less. But if you're not in the business actively doing it, you're going to have a hard time hitting the top end of the range. Renewable pricing hasn't changed dramatically. It's just that the load curve is changing as people there's more 24/7 power use coming in, and sun doesn't shine at night, wind doesn't always blow, but renewables aren't dead. They're going to.
Are you sure?
Yes, actually I am sure.
Okay.
Because there's still a place for them when they're working in conjunction with gas plants. I mean, part of our portfolio now, we actually shut off our fossil fuel plants during the day when there's a lot of sun and wind in Texas. We buy from the grid their power and sell it to our customers, generating it ourselves. Those options are still going to be available, at least in competitive markets.
Well, because speaking of, your renewable unit is 30% of your annual earnings, right? And it's 20% of the renewable market share here in the US. How much do you think that can grow for you?
Our renewable, we generally actually contract for renewables rather than own them. It's a strange thing because we own 2 coal plants. Everyone else gets cheaper renewable capital than we do, even though we're a big company and quite good at this. And as a result, what we generally do is contract for that power from other developers. Right now, we've got 2 gigs, and we're probably going to have a solicitation for more going forward. So I still see it as an integral part of our strategy. And a lot of it also will be driven by what the customers want. So at the end of the day, we are in the customer service business, not the electricity business. So it's our job to sell you the kind of electrons that you want in terms of, time, place, and fuel generation. So if you want green electrons, decarbonized electrons, we will have them and we will sell them to you.
Thank you. In terms of the actual agreements, how many agreements are you talking about that's like, hey, we're going to sign well, we like your electricity, we'll sign it, versus like firm demand, here's your paycheck?
We do this every day. We actually supply power already to every one of the hyperscalers. We have the second largest commercial C&I electricity book in the country and the largest natural gas one. So we sign those kind of arrangements. Some of them are short term, some of them are long term. I think the new data center ones will all be at least 10 and probably closer to 20 years. A, because we won't want to dedicate our site to something that's less than that. B, we won't want to build a dedicated power plant for less than that. And C, if you're going to pay all that money for those chips and to build a data center, which actually costs more than a power plant, you're going to want that kind of stability for an extended period of time. So I think a lot of those are going to be fixed price deals off market with power scale. They will still be in front of the meter because people will want to be connected to the grid, but they will definitely be long-term fixed contracts.
How soon are you signing more of those?
Stay tuned.
Okay.
Fair question. My next earnings call is May. It will not be then.
Okay.
But, we're working on these as fast as we possibly can. They're complicated. People, think electricity is just like flicking a switch. It's super complicated, but we are making substantial progress towards some very interesting transactions, talking both to hyperscalers and to developers.
Before I let you go, though, what makes it complicated? Is it the pricing? Is it how to structure the deal? Like, is your power going to the grid and then selling back to the hyperscaler? Like, what makes it so hard?
You need an interconnection agreement. You need a construction agreement. You need a turbine agreement. Now, we have all of these in place generically, but they all need to be site specific. You need to decide how big a data center you want to put on the site. How fast are you going to grow that data center? So are you going to start at 200 megs and go up 200 a year? Or do you want to start at a gig? So what makes it complicated is putting all of those pieces together. And what people forget is actually for this type of data center is new. Unlike existing data centers where people have done lots of them, there aren't a lot of AI data centers out there yet. But it's complicated, but so is general power plant development, all the permitting and those things. So it's nothing that we're worried about. It's something we actually think we're pretty good at. But
and hyperscalers are willing to put down that money.
Absolutely.
They're showing up, knocking on your door. They're there.
They're there.
Okay.
They're there. We're there. And because of the agreements we announced last week, the turbines and the contractors are there.
Our thanks to Larry Coben, CEO of NRG Energy. All right, coming up, we're going to have more from the CERAWeek Energy Conference and a conversation with CEO of GE Vernova.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We move next to the drug and pharmaceutical space. This week, shares of the Danish drug maker Novo Nordisk dropped the most since December 20th.
That's after Novo said that people treated with its obesity drug, CagriSema, showed underwhelming weight loss in a clinical trial of people with diabetes.
For more, guest host Isabel Lee and I were joined by Sam Fazeli, Bloomberg Intelligence, Director of Research for Global Industries and Senior Pharmaceuticals Analyst. We first asked Sam where Novo is now in a fast-growing market for weight loss treatments.
15.7% is what they lost in the 68-week trial. And then when you correct that for the placebo, so obviously you tell people to also diet, etc., that falls down to 12.6%. It's not a big number. Therefore, people are upset. And this was supposed to be the drug that is going to beat, they hoped would beat potentially, or be their main way of competing with tirzepatide or Mounjaro from Eli Lilly. The reality is, it's actually in this trial, it seems about in line with what tirzepatide gave us. So it's not that it's that bad. It's just these guys set themselves up a while ago saying 25% in obese, 20% or so in obese diabetics. Diabetics, for some reason, respond less. And of course, both of those have been lower. We had that one, the first one in the obesity population before Christmas, if you remember, and this one. So this market is so awful with a sea of red everywhere that it's really difficult to parse out specific company thing or people are just miffed.
Taking a step back, when it comes to the reintroduction of legislation to modify the Inflation Reduction Act, how does large pharma sit amidst all of those?
Oh, just a small question then, right? No, I mean, look, at the end of the day, a lot of these folks are being told, you're going to have within that context, we've done a lot of analysis on this. Every year, 15 drugs are chosen to be negotiated for price by the Medicare plans. So, and it's possible that Novo's Wegovy is going to be part of one of those for 2026 or 2027. I can't remember exactly. That's what's happening with these guys. But a lot of pharma companies have said, look, we can manage this. It's within our realms to be able to cope. And so I think the market has generally accepted that the IRA isn't that bad for the pharma industry.
Sam, talk to us about kind of these generic weight loss drugs. And I guess I don't know if they're generic or if they're a different term, but
Compounded is the phrase you're looking for. Yeah.
How effective are they? And how safe are they?
Well, I mean, look, the companies buy active from somebody, and they make it in the pharmacy, and they sell it to you, right? So it's usually a needle and a syringe, right? A needle and syringe and a vial. How safe are they? Who knows? No one's done trials on them. I think the FDA has to believe, and they do go through rigorous assessment, that the active that they're buying isn't going to kill people. And I don't think that there's been that much issue. But then at the end of the day, it's not the branded drug. It's not the drug that the manufacturers live and die by if there's an issue. So the reality is they should be out of the way anyway, because they can only sell what are essentially on-patent drugs, which they're not supposed to, right? If there's a shortage. And the FDA has said there's no shortage for either of the drugs from Novo or Lilly now. So those folks have to take them off the market.
Going back to this CagriSema, if Novo plans to seek regulatory approval in the first quarter of next year, what happens if it gets approved and if it doesn't?
Yeah, so look, these are all drugs that are in the evolution of the pipeline of the company. So Wegovy from Novo is often viewed as less impactful in terms of efficacy than Lilly's Mounjaro. So here comes Novo with something that matches it, with a slightly different mechanism that potentially can help you maintain a little bit more muscle rather than what you get with some of these earlier versions like Wegovy. So that's the idea, but they still have to prove that. And then, of course, there'll be another generation that will come, triple therapy from Lilly and so on. So basically what they're trying to do is to keep raising the bar, and raising the bar on efficacy and raising the bar on giving you the good weight loss, i.e. less muscle, more fat.
Our thanks to Sam Fazeli, Bloomberg Intelligence, Director of Research for Global Industries and Senior Pharmaceuticals Analyst.
This week, I was at S&P Global's CERAWeek Energy Conference in Houston, Texas.
It's where all the energy CEOs and officials meet to discuss policy and make deals.
I had the pleasure of speaking with Scott Strazik, CEO of GE Vernova.
GE Vernova is a gas and wind turbine manufacturer, and it was spun off a year ago by General Electric.
I spoke to its CEO about the company's grid investments in artificial intelligence and energy, and I began by asking Scott what he thinks the biggest change is leading the company in the last year.
I'm proud of the first year, but most importantly, it's really just the beginning for us, because a lot of these trends, whether it be AI, whether it be the electrification of these industries, it's really just starting. So our end markets continue to strengthen. I think there's a more reality-based focus on both the need for gas and nuclear. So the demand cycle for both of those continues to get even stronger today than where we were 12 months ago. And it really then comes back to how do we deliver safely and in a high-quality way to serve this incredible market that we're walking into.
I mean, your backlog is huge, right? It's like $73 billion, right?
Sure.
Can you give me perspective, like how much of that is AI demand driven? How much of that is like wind stuff? How much of that is transformers? Which is the stuff you got to plug into the grid? You bet. It's still a very small proportion of our backlog is directly attached to AI. I mean, when you really think about even data centers in total, there's only about 60 gigawatts of data centers globally today, and only 15% of that's really explicitly related to AI. Most of it's still cloud and storage. So that's why there's so much growth to come, because we're really just starting. But I'm sure us sitting down a few years from now, it's going to be a larger proportion of our backlog. How much do you think it would be? Best guess? Oh, it's going to be a lot more. There's no question about it. Or no, I don't think we get to that proportion, but it's going to become more AI-centric, and it's becoming even more U.S.-based, because the amount of growth that we're going to see in the U.S. the rest of the decade relative to the rest of the world, it's going to be more tomorrow than it's certainly been the last 5 to 10 years. In the meantime, you cannot get a CEO on the stage at CERAWeek that isn't talking about GE Vernova, because everyone's buying your gas turbines at the end of the day. How much of this is firm contracting? How much of that is just like, yeah, we like it, we're going to buy it? Can you give me some insight into that?
Well, we're very firm in contracts, certainly with our gas turbine, our transformer, our switchgear backlog, really through 27 into 28 right now. I would expect by the end of the summer we'll be largely sold out through the end of 28 with those equipment. But we're also looking to kind of find ways to get better every day in a culture of continuous improvement. And if we can increase capacity smartly as we figure out this ramp, we'll do that. But for context, last fall, we announced a really almost 35% increase in supply from 25 levels to 27. So 35% increase is a lot. It doesn't mean we stop there, but we've got to get there first to then reevaluate what the art of the possible really is.
Okay, so to that point, what are the issues with execution then? Like, it's a lofty goal, right? You're investing $600 million to expand plants in the U.S. It's a lot. How fast can that happen, and what are the roadblocks for you? It's
got to happen in the next 2 years. You know, really, this company is going to look very different between now and the summer of 26.
What's the biggest hurdle for you to get that done? Workers? Prices,
we're going to add over 1,500 employees. That's a combination of engineering and craft labor. That's all in the U.S. Take gas as an example. We've got to add over 500 heavy-duty pieces of machinery into our global factories to drive this growth and this ramp. So that's a lot in existing factory footprints. We're highly capable of doing it, but it's a lot between now and, let's say, the 4th of July of next year. So I like our chances, but there's a lot of work to do.
Talk to me about the wind part, okay? Because that's sort of like the cousin no one wants to talk about right now, right? Or the uncle. If someone came to you and said, "Hey, Scott, I'd like to buy your wind business," would you be like, "Yes, take it off my hands"?
No, I don't think it's that simple. Okay. I think at the end of the day, we've got a big onshore wind business today. Even in the U.S., we have over 35,000 wind turbines that are spinning, creating electricity today. We see real opportunities to repower that existing install base using the infrastructure that's already been built, but putting longer blades onto the wind turbines that helps the world. We think there's a role for wind, and with that role for wind, we're focused today on just operationally running this business better every day, waiting for the growth and inflection that comes. So we really are a believer in an all-the-above technology suite. But we'll also look at our portfolio every day with a steely eye on what creates value for our shareholders, but there's no binary yes or no answer to that question, but we're focused on running these businesses better and ultimately creating value.
All right, so sticking to the wind. The other part of your business, which I think is so cool, are the transformers. So that you can have all the wind farms you want, all the solar that you want, but if you have to plug it into the grid. So I think of it as like a big socket. I'm sure it's much more complicated than that, but talk to me about the growth there, because everyone talks to you about AI and data demand, but like that's where the potential growth is. Walk me through the percentages.
And that's also for context where a lot of our first interactions really came to be more intimate with the hyperscalers. I mean, we did over $500 million of direct electrical equipment with the hyperscalers and orders last year with transformers, with switchgears attached to their data centers. That's a business that we see substantially growing from here. 2 years ago, our backlog coming into 2023 was about $6 billion equipment backlog. It's north of $20 billion today. So
what's the growth rate?
It'll stay growing. Our backlog certainly will grow at that same level for another year here at expanding margins. So this is, I think we can have debates between nuclear, gas, wind. What are the power generation sources that are going to power the world? Regardless, we need to invest in the grid.
Yes, and that then leads us to transformers. Before I let you go, North America is what, like 20-25% of your business right now. Uncertainty is quite high. We saw it with the NFIB, a survey of small businesses. Is now a good time to invest in the U.S.? And what part of that business do you think it could be in the next 5 years?
I think it's a great time to invest in the U.S., yes. We've gone through multiple decades with very little load growth, and it's really impossible to underwrite a case that we don't need substantially more electrical equipment and supply here over the next decade. And yeah, that's data centers, but it's not just that. We're reindustrializing parts of the U.S. to an extent that is going to require more electrical load, you know, EVs, home heating. There's a lot of other factors, and beyond that, we just need to modernize what we have for resilience and energy security.
How big of a percentage could the U.S. or North America be in your portfolio in 5 years?
It's going to grow as a proportion for sure, but it's not the only market. We're continuing to see real growth in Asia and in Europe, but we're very bullish on the U.S., and we're going to keep investing in the U.S. You cited the $600 million and 1,500 jobs attached to that, but that's not the end. That's just the beginning as we continue to serve this market.
Our thanks to Scott Strazik, CEO of GE Vernova. Coming up, we'll have more from the CERAWeek Energy Conference and a conversation with Joe Dominguez, the CEO of Constellation Energy.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We move next to the retail space. This week, the department store Kohl said that comparable sales this year will drop as much as 6%.
This comes as the company has been making sweeping changes in an attempt to get back on track after 3 years of declining sales.
For more, guest host Isabel Lee and I were joined by Mary Ross Gilbert, Bloomberg Intelligence Senior Equity Analyst covering retail. We first asked Mary about Kohl's guidance and why it came in weaker than expected.
With regard to Kohl's guidance, first of all, I think they're really hoping to beat the numbers, but they're expecting their comp sales to be down 5 to 7% in this coming year. And if you look at the performance in the fourth quarter, their revenues came in sort of in line, fairly close. Their comp sales were down about 6.7%. But when you look at what's going on, the Sephora business was up 13% on a comp basis. That means that the rest of their categories, and they're mostly apparel related, were down double digits. So it's very concerning because that Sephora business, since they brought it in, is now $1.8 billion in annual revenues. Meanwhile, they lost about $3 billion in revenues, and now we're looking for further declines this year. So that's what's really concerning. Now we have a new CEO. This is the third CEO in 4 years, Ashley Buchanan. And, you know, he gave a quick peek at what he sees are the opportunities. They need to really get their merchandise assortments right. They did bring back in private label, jewelry, and petites, because those were some of the things that they took out when they brought in some new brands. And they found that they were alienating their core customer. Another issue was on the promotional side. They always have these great little coupons, but what they did was they had raised the number of brands that were excluded from the promotions to an all-time high in 2024. Their objective is to reduce that to make it more compelling. So they have a number of strategies that they have to employ here, and it's going to take time. So that's why the outlook for this year looks dismal, along with the fact that the consumer climate, particularly for their low-income cohort, are challenged by still high inflation and just an uncertain environment with the ramifications of higher tariffs.
Among the many things that jumped out to me is why they're bringing back fine jewelry. How do you square that with a struggling consumer base? They're not the latest retailer to cast doubt on the strength of the U.S. consumer.
Yes, Isabel, so it's a good point, but it's important that you have that for a gifting option. And these items are not, it includes not just fine jewelry, but also costume jewelry. And that category, because they did bring it back in, their sales were flat. So that shows that that strategy of bringing it back, because it's very important for gifting. And once again, if you look at the promotions that they offer, for jewelry, they have buy one item, get the second item like half off or something like that. So they do have some compelling value that they're bringing the consumer there. It's important for gifting. So for example, for Valentine's Day, and then also, you know, for the holidays.
What are they saying, Mary, about tariffs and their ability to pass along price increases or conversely take it in their margin?
Yeah, so tariffs, it wasn't a huge topic on their call. And if you look at the past, they weren't really impacted. They were able to pass it on. And I think what they do is they work with their vendors and they source. So if you look at their private/exclusive labels, that business, they're able to, you know, they haven't disclosed exactly how much they source from China, but they're able to basically work with their vendors on you know, creating that price, the product at a price point that fits into their value equation. And so the last time around, if you looked at 2018, 2019, they really didn't call out a specific impact related to tariffs. They said that they were okay. They were able to offset it with either cost savings or just the way that they were able to price it in terms of building the margin.
How about store visits? Kohl's isn't the only one struggling with that. I myself have just shopped basically online. How are they attempting to attract customers back in store?
Yeah, so Isabel, actually their stores performed better. Now remember, they were, the sales were down, but they outperformed online. So, earlier in the year, we had seen where online did better than in store, but actually, the stores are doing better than online. So they're actually, and we're seeing that from a number of retailers where we do see really good performance in store. And if you look at off-price, that's really based and built on in-store visits.
Our thanks to Mary Ross Gilbert, Bloomberg Intelligence Senior Equity Analyst covering retail.
This week, I was at S&P Global's CERAWeek's Energy Conference in Houston, Texas. It's where all the energy CEOs and officials meet to discuss policy, make deals, and talk to shareholders. I had the pleasure of speaking with Joe Dominguez, CEO of Constellation Energy.
Constellation operates the largest fleet of nuclear reactors in the U.S., and the company recently signed its largest ever power purchase agreement with Microsoft.
It's a deal that will restore Constellation's 3 Mile Island nuclear plant, and it shows that carbon-free electricity is more valuable when it's available around the clock. I began the conversation with Joe Dominguez by talking about the company and asking about recession and slowing growth and whether he's noticing any of that at Constellation.
We don't see an end in sight right now. We're starting to see it get rationalized, and by that I mean we're not seeing the same requests for data centers popping up in 5 or 6 utilities. So I think the hyperscalers are beginning to figure out where they want to go, and it's not the frenzy of activity. But in terms of the deal pace, it continues the same way we saw it last year.
And how are the deals? How is it to get them done? Is it hard? Is it coming up with the structure, the money? What is it?
It's not hard, but they're complicated because they're multi-billion-dollar deals, right? So we're talking about 20-year deals for power that sometimes could cost $5 or $10 billion. So like any commercial deal of that scale, it's going to take a long time to negotiate. And each time you need to do that with a new party, you have to go through all the terms and conditions again. But I think we're going to get some deals done this year.
Can you give me some hints, in maybe areas, what kind of deals, what kind of power?
Well, I think nuclear continues to be very attractive for the hyperscalers because it operates 24/7. It's clean, so it meets their environmental goals, and it matches up really well from a reliability standpoint.
So let's go to money then for a second.
Sure.
So coming up with the deals is very interesting, particularly the one you did with Microsoft to restart 3 Mile Island. Are your costs going up right now?
A little bit, but it's really labor inflation that we mostly see. Now, remember, we have existing nuclear plants that are already built. So a lot of the cost of the raw materials that you're seeing, potentially impacted by tariffs in the long run, but an escalation through inflation. We're not seeing much of that. Tiny bit on uranium pricing, but most of what we're seeing is labor contracting.
If you wind up seeing an increase, right, even in labor, how does that change then your contracts? You've already said it, you have to go back to them and say, hey, listen, we got to renegotiate, my costs are going up.
No, there's no reopeners up or down for those sorts of inflationary
So you're really
pressures.
taking on that risk then?
Sure, yeah, and we're taking it on for over a 20-year period. And that's the importance of being able to do this with nuclear, right? We know exactly what our cost structure is going to be within a range for 10 and 20 years. Harder to do with our natural gas assets, where we don't know what the price of natural gas is going to be 10 years out, or whether we're going to have a carbon tax, or what the changes in environmental regulations are going to be.
So how do you manage that risk?
Well, I think what's really difficult to do that in the case of natural gas. I think what you're doing is something that looks more like an index product that is indexed to either inflation or natural gas prices.
When you talk about the different parts of your business, how much of the CapEx that you're spending is going to new stuff, beefing up old stuff, or just replacing and making sure everything stays on track?
Yeah, so for us, Alix, we face a critical decision as to whether to relicense the nuclear plants for another 20 years. And we're facing that across the fleet. So when you say new, if we don't do this, it's going to be retired, very much like 3 Mile Island was retired. So the distinction between keeping existing open And something that's truly new is immaterial, right? If it's gone, it's gone. It's the same as if it were never built. So we are investing all of our monies to secure that fleet for the future. And we're also doing upgrades and restarts and other things like that. In terms of a percentage, to your question, I would say 90% of our spend is in the existing assets and getting them ready to run for decades to come.
So when we talk about power demand booming and increasing by multiple digits, right? I mean, 10%, 7% would be huge. How do you play that? Like, if it's not new, is it just expanding?
Well, it is expanding. A lot of our clients are interested in uprating. That's increasing the output of existing nuclear plants, and we're doing that in a number of different regions. Obviously, the restart is more limited. You had one plant there that you could turn on, and I think there might be another in the nation. And then the rest of that is going to be probably spent on renewables, storage, and natural gas for the time being, and in the fullness of time, new nuclear.
M&A for that? I know you just bought Calpine, so that really beefs up your natural gas. Nuclear is now 50% of your portfolio versus, say, 70%. That was a big shift. What else is in your pipeline for that?
Well, we've got a lot on our plate. We've got a lot of food to eat. Yeah, and so this year we're going to spend making sure that we're ready to integrate Calpine and prepared for regulatory approvals at the back end of the year. But as you said, it's a big deal. And I think what we've indicated as a company is M&A is a big part of our strategy.
Yeah, yes. M&A in beefing up nuclear, natural gas, or you want to diversify
all
into
of
other?
the above. All of the above. I think storage is going to increasingly be a part of the story, so we'll look at those opportunities as well.
Everyone now wants to get into power. It is the coolest thing right now in the market. Whether you're looking at integrated utilities, regulated utilities, even energy companies, are you seeing more competition?
I think what people are trying to figure out is whether they too can secure longer-term contracts. I don't see people building spec power plants hoping the demand will come. So I think there's going to be a lot of interest there, but it's largely going to be fossil. It'll continue to be renewables, but it always has been renewables, and then we'll see whether they could get deals done.
Our thanks to Joe Dominguez, CEO of Constellation Energy.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.